From our studios in Scottsdale, Arizona, welcome back to Retirement News Online. We talk about things retirement planning. And taxes don't retire when you do. In fact, they often become one of your biggest controllable expenses. Now, smart advisors help clients reduce lifetime taxes, avoid surprises, and create more efficient income in retirement. Joining us to talk about this is our good buddy Josh Reaves with Swarm Financial in Atlanta, Georgia. How are things in Atlanta these days? Is it okay there?
Yeah, Atlanta is booming. It's having one of the biggest booms it's ever had, I think. You know, a lot of growth, a lot of population growth, yeah.
So when it comes to tax planning, that's one of the biggest, as we said, the biggest controllable things in retirement, you know, when it comes to Social Security. But it really is an issue that a lot of people forget. When you start taking income, when you start adding things like Social Security, when you have less deductions, like you've paid off your house, for example, in retirement, you're often in a higher tax bracket in retirement, which is something that people don't expect. Would that be accurate?
Absolutely. People don't think about that. You work hard and you think about building equity in your home and paying it down, but when it comes time to actually retire, you start to look at the sources of income, and we find that a lot of our clients have never had those discussions. They're not thinking about that. And so when they come to us, it's really important that that's a framework, a foundation for what we talk about with them, for any kind of retirement discussion, helping them to start to think about that. And I think they find they appreciate that because their CPA is not talking about that with them.
No, they're not.
The accountant's not talking about that with them, especially if they're business owners. They're so focused on running their business oftentimes that they're not even really looking at long term what the taxation is going to be for them or their family.
And don't get us wrong, too. We appreciate CPAs and accountants because we need you guys to prepare the returns, but oftentimes we also need another aspect, which is actually tax planning, which is looking forward a little bit. So unexpected tax jumps, IRMA charges, required minimum distributions, we all say RMDs, but a lot of people, they really haven't talked about that with anybody, that at age 73, the government wants to get paid back. And guess what? They had a plan. They're going to make more money off of you than you deferred. So we have to really plan aggressively around that, don't we?
You do. And there's no one-size-fits-all solution. So you have to really understand every client's situation and what their concerns are, or what the potential is, for those types of fluctuations and how it may impact, their retirement income. So, really need to start with kind of gathering that information and assessing, what those risks are so that you can help to factor that in. I mean, all of this can be modeled. That's the thing, Scott. All of this can be modeled. When you have the right inputs, when clients share information with you, and that's really key, is getting them to trust you and be willing to share, because we can't make recommendations for our clients if we don't understand, what are their concerns, what are they doing to build this income during their working years, so that when their distribution years start to happen, we can start to figure out how that taxation could affect that, during those times.
And I hear a lot of people talk about taxes are on sale right now, and we expect them to go up at some point. That would make like a Roth conversion probably a good idea, but that's not always the case, even when tax rates are low like this.
Sure, Roth conversions can be very effective, especially for high income earners, for people that are over 59 and a half, that are approaching retirement age. It's not a solution for everyone. I think it really, again, goes down to really understanding how you can use that as an effective tool. Quite frankly, that's one tool in the tool belt, right? There's other tools that you can use to help them, understand how to, decrease their taxes, or at least to, predict and manage their tax brackets in retirement. We are at the lowest tax brackets that we've ever seen. And so, some Roth conversions can be a great way during this time to try to take advantage of that, to turn in tax deferred money into tax-free money later on. So being strategic about that is really important. And if you're not having those discussions with your financial advisor now, you should be, and you should be, interrogating, understanding, why aren't we having that discussion? Because it's really important now. Why aren't we taking advantage of what we can? Based on what's available to us now.
Yeah, so again, it's important to be with the right advisor. You guys are retirement specialists, so you're in many ways, you're not one-dimensional. You're independent. you have the universe of solutions available to you, but you do everything from, yeah, we can accumulate, but we have to make sure that we have a distribution plan, and part of that is going to be minimizing taxes going forward, because again, when you're taking income, that changes everything. I really appreciate your time. Josh, thank you so much. Josh Reaves, Swarm Financial in Atlanta. If you'd like to learn more about Retirement News Online, go to retirementnewsonline.com. Thanks for watching.